will come through the bond market. I think right now it's unpleasant because the regime has shifted.
It is not a good thing to raise interest rates to kill the economy.
In 2021, the firm was loss-making, and as a consequence of that, obviously, we have to have a lower bonus pool.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Credit Suisse reports a quarterly loss of $2.2 billion. Our interview with the chief executive, Thomas Gottstein, this hour. Unilever warns that inflation will dent its profitability for 2 years. Our interview with the chief executive, Alan Jope, also later this hour. And running hot, traders count down to key inflation data from the U.S. A higher than expected reading could push the Fed closer to a super-sized hike. Now, first thing is first, we have a great market, of course, reaction from guests across the world, but this is what markets are doing right now. Now, we did actually start the day higher with the European stocks. Now they're drifting lower. The focus is not only on earnings, and let me tell you, we've had a good crop of earnings in Europe. Then a little bit later on, we look onto PepsiCo and Coca-Cola in the U.S. Disney, yesterday in the U.S., also beating expectations, but there are a couple of downliers. So if you look at Credit Suisse, it's down 5%. Also, a lot of the focus is Unilever after disappointment in terms of strategy. The focus will definitely be on the Italian 10-year yield, whether that moves because of expectations from inflation. That is after we have euro area inflationary numbers a little bit later. But also, we have a great Bloomberg scoop saying that more and more some of the economists and certainly some of the central bank governors just do not trust their own inflation expectations in Europe. So once again, watch out for some kind of differential between German bonds and some of the periphery, including Italy, but also Greece. The other thing we need to watch out for is what the CPI inflation data in the U.S. does to the rest of the world. We're now seeing more and more differentials between the Bank of England, what they're trying to do, or the messaging they're trying to give the markets, and of course what the Fed will try to do. So some of the earnings that we're watching, and again, I was counting, I think about 12 companies, big companies in Europe reported. I had a conversation with the Credit Suisse chief executive, down some 4.6%. They've been through a lot of pain, that $2 billion loss. The focus now is execution. He told me they're not changing strategy. What investors want to know is how do you speak to shareholders? How do you retain talent, but also get clients back on track? This is going to be the main challenge for Mr. Gottstein and the team. And then Unilever, Danny Berger also spoke to the chief executive, down 2%. It was the first time that we spoke to him since that activist investors really trying to push on him, and the fact that they had to, walk back an acquisition that they wanted to do, and then Société Générale, by all accounts, blow up numbers. One of the biggest gainers in today's trading session, gaining some 4.5%. So what investors are really bracing for today is what could be the hottest inflation print since 1982 in the U.S. January CPI data due out later today, expected to show a 7.2% annual increase. Now, anything above that, of course, will add to the chances of the Fed making its first 50 basis point rate hike since 2000. But Nobel laureate Joseph Stiglitz says that could be a mistake.
It is not a good thing to raise interest rates to kill the economy in order to beat what is still moderate inflation, 7%. At the current juncture, if you raise the interest rates, it will slow down the economy. And the first order impact is going to be on unemployment. People who might otherwise have gotten jobs won't get those jobs.
Well, we're joined now by Claudia Panzeri, head of equity strategy and tactical asset allocation at UBS Global Wealth Management. Claudia, thank you so much for joining us. So what's the reaction function of the markets, depending on what kind of inflation print we get from the U.S. today?
Yeah, it will be something. Good morning already, Francine. Thank you for inviting me today. Really, I think the market is weighting this number very carefully, because if you have inflation which is much higher than actually expected, you may have a market reaction which is different from what we are expecting. Probably bond yield will fall rather than rise, because people will expect the central bank to hike in rating too much and kill the growth. I think it's very important. We still expect inflation to cool down in the second part of the year. There are a number of elements which should support this view. One, consumer goods demand should decrease in the second part of the year. The lead indicator rolling over already, supply chain disruption are normalizing. So we expect CPI, not probably today, but in the month to come, to be normalizing back to long-term levels.
So, Claudia, what does it mean for some of the positions that you want to take if you believe there will be rising rates? Where do you go big in stocks?
We go big on energy and financial. We have been very well exposed to this sector since a while now. They are behaving quite well since the beginning of the year. If you have inflation concern, then on commodity space, you are well positioned. So clearly, we tend to be exposed to sectors, stocks, and country which have a positive correlation with inflation, but also which are showing strong earnings and GDP growth. I think this is quite important. The market is start to make a big distinction, a discrepancy between what is growing and what is not.
So, Claudia, is there anything that you're selling off right now in preparation for these rising interest rates, or has it already played out on the markets?
We are already well positioned. We this since last year, with short duration already, the market has been repriced quite well. Central bank, the market has been except tech, but the overall market ex tech has been quite resilient. And I think the growth on the earnings side, as you were mentioning before, is a key leading indicator to watch. So we are not changing our positioning on one data. Of course, we are well positioned on inflation, on change in monetary policy, but we have also a portfolio which are pretty balanced because we also have defensive sector into our allocation.
So, Claudia, for example, how do you build in some defense in there? What's your ideal allocation in your portfolio?
On our global sector allocation, we have, for instance, this most preferred on energy and financial, but we also have healthcare. We clearly see healthcare to be cheap across the world, especially in Europe. If you have some deception on central bank hiking rate, that the pharma cheap sector may help. They also have less pressure on inflation. So that is a way. On the other side, on the negative side of the global level, we are more careful about industrial, real estate, and consumer staple. We are concerned on some defensive name that inflation could have an impact on margin. So we think healthcare is more protected than consumer staple at this stage.
Yes, so I don't know how you play commodities, and actually I guess the million-dollar question when it comes to earnings, that it really seems that investors like these companies which have a lot of price power and that can increase prices. What happens to the companies that can't do that?
So on the commodity side, we have double exposure. We have a double exposure because we are exposed to the energy side, clearly in our mandate and in our global sector allocation, but also through commodity themselves. So we have been rising our expectation and forecast for the brand for this year, and also the overall expectation on the overall commodity bucket is still very positive. We have a double-digit expected return from the coming months. So we are able to be exposed both to the stock side and to the commodities themselves. Then within the Eurozone in particularly, we also like materials, which is a mix between metal and minings and chemicals. That is another way to be exposed to commodities.
Claudia, overall, I think the million-dollar question is whether if you see a hawkish pivot from the ECB, does this support a stronger economy or is it just a supply issue? And I guess, that changes everything.
Yeah, that changed everything. I think the supply chain is not back to normal, but is normalizing. The inventories are start to picking up. They are still very low. The number of finished products are increasing as well. So there are a number of elements which are telling us that the supply chain disruption is normalizing a bit, not back to pre-COVID level, but clearly there is less pressure coming. The second element is lower consumer demand. We have been consumer good demand to be extremely high over the last 15 months. This consumer demand should normalize, which also bring back some pressure on supply chain. And overall, the picture is the one where the growth is still well-oriented, but growth should come from services side, where the inflation pressure is lower.
Wonderful,
and then
Claudia,
you
thanks so
mentioned
much.
on the central bank, of course.
Yeah, on the central bank. Hawkish because it's good news, or hawkish because of supply issues?
Bank. Hawkish is a good news for banks which have been negatively impacted by negative real rates. So being still exposed to financial makes sense at this stage of the cycle.
Claudia, thank you so much. Claudia Panzeri, their head of equity strategy and tactical asset allocation at UBS Global Wealth Management. Now, let's also go to some of the earnings that we saw late last night in the U.S. that will play out today. Disney. Now, subscribers to the Disney Plus actually increased by 11.8 million. I have to say they actually beat by all accounts on parks, on streaming, and some of the other things that they've actually put out there. Now, remember, this is a new chief executive in charge. He's, chief executive of the world's largest entertainment company for 2 years this month. And of course, the current period is really the first time since the departure of the longtime Disney leader, Bob Iger. You can see that share price pre-market gaining some 7%. Also, Uber coming out with sales that beat estimates. This is because ridership has been resilient. That, I'm sure, is tied to the pandemic, but also they've just delivered more food and other things, maybe more groceries to a lot of people around the world. Uber pre-market gaining some 5%. Now, coming up, we'll be taking a look at the possibly the new sick bank of Europe. That's Credit Suisse. We'll have a full roundup after our conversation with the chief executive. This is Bloomberg.
The fact is that in 2021, the firm was loss-making, and as a consequence of that, obviously, we have to have a lower bonus pool. But we also included a new form of compensation in terms of our SDP, Strategic Delivery Plan. And this was very well received by our employees. And Credit Suisse is very committed to pay market rates in terms of compensation. We have a very long-term strategy in Asia. We see a huge opportunity there. The growth opportunities are very attractive. It is not a market you go in and out. Other banks have gone in and out. We have been committed to Asia. It's very clear that at the moment China is somewhat less predictable in the short term. But the opportunities across the whole region are tremendous. We are fully committed. We are investing in Singapore. We're investing in Greater China. We're investing in India. We're investing in other areas. So Asia continues to be absolutely core to our growth strategy, and nothing changes.
What kind of conversations are you having with your main shareholders? Are they asking anything of you?
I think the shareholders are very focused that we are now sticking to the strategy. We have a strong balance sheet, that we want to be a stable bank, and that we are implementing what we have announced in November.
Why not publish the Green Seal report?
The Green Seal report was completed. It was shared also with FINMA. The board took all the relevant decisions with respect to disciplinary actions internally. But given the ongoing efforts in terms of retrieving the money from the various obligors, at the moment, there is no intention to publish the report.
Do you think it will be published at a later date for the sake of transparency?
There are no plans to publish it. No, it was an internal report which was commissioned by the board, and there are no intentions to publish it.
You've had a tough 12 months. Is that fair to say?
Yeah.
I mean, it hasn't been dull.
Definitely not dull, no.
Is 2022 going to be any better?
I hope so, and I am confident it will be.
What was the hardest thing in the last 12 months?
Well, there was a lot of distraction, obviously, with dealing with the Archegos and the supply chain fund issue was not an easy thing, and we had to go through a very detailed, inward-focused period where we really had to review all our risk positions, our risk processes, and to really invest. But we have now really a strengthened team, As you know, we have 7 new members of our 12-man executive board. And we have really a great team together. We are energized and we are focused now on implementing the strategy in 2022 and beyond.
Well, that was my conversation with the Credit Suisse Chief Executive, Thomas Gottstein. And of course, the stock on the move, on the downside, some 4% lower. Now, we'll get more analysis on the Swiss lender with our banks reporter, Steve Ahrens, and also the Algebris Chief Executive, Davide Serra. He's a good investor in banks. Always great to get his thoughts on where the pressure points are. Now, let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. The UK is putting more troops on standby to support NATO in the event Russia invades Ukraine. Government officials say the additional 1,000 army personnel would help in a humanitarian response in the region should it be needed. Separately, the UK is also expected to set out sanctions legislation as soon as today. Moscow has repeatedly denied plans to invade its western neighbour. England is scrapping COVID self-isolation rules, bringing to end the last of pandemic restrictions that have dominated life for the past 2 years. The move, brought forward by a month from the end of March, puts England beyond other major Western countries in relaxing curbs. The Boston Fed has tapped economist Susan Collins to be its next president, making her the first black female to lead one of the central bank's 12 districts. Collins has a doctorate in economics from MIT and currently serves at the University of Michigan. She replaces Eric Rosengren, who stepped down last year, starting in July. Boris Johnson is under even more pressure after UK police said they are contacting more than 50 people over parties held in the Prime Minister's office during the pandemic. This as a new photo emerged yesterday of Johnson pictured at a Christmas event with what looks like an open champagne bottle on the table. New York State is lifting a mask mandate for businesses, citing high vaccination rates and low COVID transmission levels. Governor Kathy Hochul says local authorities can continue to determine their own rules. Face coverings will still be required in schools and healthcare facilities across the state. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. The alleged open bottle, I hope it was at least British sparkling wine and not champagne and not Prosecco. Coming up next, we speak to Davide Serra from Algebris on the banking story, rate hikes and the impending tightening of global monetary policy. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance, early edition. I'm Francine Lacqua here in London. Now, it has been a rough couple of years for Credit Suisse. Today's results confirming it might be better known as a sick bank of Europe. But it wasn't so long ago that this unfortunate distinction actually belonged to another lender, and that was Deutsche Bank. Well, joining us now is the Algebris Chief Executive, Davide Serra, and intimate knowledge on banks, and our banks reporter, Steve Ahrens. Steve, there's a great story actually on the Bloomberg terminal, and good morning to Davide. But there is a great story, Steve, on the Bloomberg terminal, which is basically our big read, looking at Deutsche Bank, and since it was considered the sick bank of Europe. So what parallels can you draw now between Credit Suisse and Deutsche Bank? Is Credit Suisse the new Deutsche Bank?
Yeah, thanks for having me. It's really quite interesting. It's really intriguing. I'm the Deutsche Bank beat reporter, and as you said, I've been reporting on what was the sick bank of Europe for a long time. And what's really interesting, the parallel is it took really a long time for Deutsche Bank to descend into chaos and into to earn that moniker. Really, a lot of missteps, a lot of annual losses, many turmoil, many executives leaving the bank, talent drain. All of these things are now happening at Credit Suisse. So it seems like we're just at the beginning. And if Credit Suisse, if the Gottstein, the CEO, and Lehman, the new chairman, if they can't draw a line under this and make it stop, then at some point, certainly, it will continue. We see credit rating downgrades and so on, and the cycle will just worsen.
Yeah. I mean, if they can make it stop, I'm sure they'd be very relieved, Davide, but it's actually a huge task. And at the moment, they're losing people because they're not paying them enough. Shareholders are probably fed up because it's exhausting following this bank. And if you're also a client, you'd have thoughts about whether to stay with them.
Yes, I think there's one
structural difference vis-a-vis Credit Suisse and Deutsche Bank. Deutsche Bank domestically has been facing basically 70% of state-owned banks, but really do not want to make money. So in a market where you have a 5 to 10% market share domestically and nobody else wants to make money, that is a structural problem. Secondly, the hiring and firing process, it's a nightmare in Germany. And as a result, the domestic core business was under threat. So that's why Deutsche Bank had to go in the States, acquire Bankers Trust, and basically went for a global conquest, which, as you want to fight as a German bank in the US, is not very smart. And hence, that's why I've had to retrench. In the case of Credit Suisse, it's different. They do have a domestic market that is profitable. They are the second incumbent. It's an oligopoly, so it's profitable. They do have a profitable asset management business. It's a reality that's been mismanaged. They basically picked wrong clients and wrong risk. So there's nothing structurally wrong as long as people do not keep on making mistakes. And clearly, I think all this turn in strategy over the years now are ultimately paying a price.
Yeah, I want to ask you whether, by, I guess, becoming much more risk averse in Asia, do they just become like any other blind bank? So we'll talk a lot more about strategy for Credit Suisse. Thank you, Steve. We'll be back with Davide Serra, Chief Executive Officer and founder of Algebris. We'll also talk about the widening yield spread between German bunds and Italian BTPs. This is Bloomberg. Credit Suisse reports a quarterly loss of $2.2 billion. Our interview with Chief Executive Thomas Gottstein this hour. Unilever warns that inflation will dent its profitability for 2 years. Our other interview with the Chief Executive Alan Jope also later this hour. And running hot, traders count down to key inflation data from the U.S. A higher than expected reading could push the Fed closer to a super-sized hike. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, first thing is first, let's check in on the markets. We're seeing markets actually drift a little bit lower. We had nice little support from the European stocks, mainly because we had some better than expected earnings results across the board. I know Credit Suisse is under pressure. I know Unilever is under pressure, but actually Société Générale was a pretty blowout number, getting some 5%. Now, the travel and leisure stocks in Europe, I think, one of the biggest gainers. Overall, it's all about the inflation report. Not in Europe, but we are getting an indication of that in about half an hour, but really in the U.S. That could reprice what we're expecting from the Fed, and it could move yields across the board. You can see the Italian 10-year yield, one of the most violent moves against, for example, the German Bund in the last week, currently at 1.817. Also, Credit Suisse and Unilever, because I was mentioning those, let's have a quick check on what they're doing. So if you disappoint earnings or if you disappoint investors, then you can get punished pretty hard. Credit Suisse has a problem with retaining talent, bonus pools, but also how they get clients back, maybe especially in Asia, down some 4%. On the flip side, Société Générale, one of the biggest gainers. Now, investors really bracing for what could be the hottest U.S. inflation print since 1982. January CPI data are due out later today. Expect to show a 7.2% annual increase. Anything above that will add to the chances of the Fed making its first 50 basis point rate hike since 2000. Now, speaking to this program, the BlackRock Vice Chair, Philip Hildebrand, said that he sees no sign of runaway inflation expectations.
If you look at the U.S., they have remained reasonably stable. So there's no sign yet of kind of runaway inflation expectations at the moment, but it's a risk, but it's not really in the data. You can also look at what the market is pricing in as a full cycle. And interestingly, in the U.S., the full cycle hasn't really changed very much.
Well, joining us with the very latest, Davide Serra. Before becoming founder and chief executive of Algebris, Davide was also senior European and global banks analyst at Morgan Stanley and UBS. Frequently consulted by the world's central banks and regulators on policy matters, Davide is recognized as one of the world's leading experts on financial services. And I guess the concern is, what if we get it wrong on inflation? So the banks are expecting interest rate normalization, which will benefit them. But what if this is an inflation that's on the supply side, and actually we shouldn't hike at the moment?
Let's say we've already got it wrong, because for 10 years, central banks have been forecasting inflation and getting it wrong. Yeah.
Why?
And I think one of the key central banks told me, says, had they thought that after printing $30 trillion, they hadn't seen inflation, yeah, they said 10 years ago, you would have fired people in the central banking job, would not even been able to be employed. So the reality, it's a complex phenomenon, and it's a mix. There were three main drivers. You had people, coming in the job market, so basically WTO, then you had technology, and then you had the disintermediation of price formation. So think about it. Every time there was an intermediary, so think about an airplane ticket, today is cheaper than it is 20 years ago, despite full price double material and people more expensive. Why? Every intermediary got cut off. COVID accelerated this. I think the green transition is the truly step change in terms of inflationary pressure. Why? It's very simple. We need to adjust 50, 60, 70 years of industrial revolution to make it sure that it's green compatible. And the beauty of green compatible is if we have 3 high degrees at the National Museum of History that tell us that here we could be swimming. Yeah? So in 78 years' time, you might need a pair of fins and a snorkel in London. Hence, it's not that you can't avoid it.
Is this an investment strategy, actually, because of the rising sea levels?
You have no choice.
Of course, but so what does it mean, actually, in terms of inflation? So we could live with this kind of inflation if this is a transition problem because we've underinvested in old school things that we need to dig up of the ground.
Yes.
This inflation could be here for 4 or 5 years.
I agree. And so our view, listen, since the fourth quarter of 2010, we said inflation is higher. Structural inflation now is around 2 to 3.
Yeah.
Now, and you need to consider that the massive fiscal lever plus negative rates plus quantitative easing has actually increased house prices and rents, and those ones typically are a third of basically, people expenditure.
So, Davide, do you think we're behind the curve? And
Yes.
could we see, I mean, how behind the curve are? Is this the biggest policy mistake of our lifetime? Because you also have people that can't make ends meet if inflation goes at 7% and stays there.
Yeah, I think there are 2 mistakes. One mistake was last year to kept on quantitative easing and equity rates for too long. They could have gone to neutral easily, both in Europe and in the States and in England. So basically, they were backward-looking rather than forward-looking. So they already made a mistake. Second thing they have a mistake to do is, in my view, increase fiscal and hike rates slowly. But at the end of the day, if the basic part of the population is getting squeezed between national insurance increase, rents, and let's say energy bills, I think what you need to do is tax subsidies. Yeah, but you cannot run the economy thinking that you cannot increase short-term rates.
But what happens to deficits?
Well, deficits are going to go up, but everywhere are going to go up. And so basically you have a disinflation. That, though, is going to feed into inflation. So that's why, in my view, they need to hike rates at least, let's say, 2% in the States, 1% in Europe, and somewhere between 1 and 2 in the UK, if you give me a 2-year view.
Okay, so that A is not priced in. And why is it so difficult for central banks to look at inflation? I mean, we should have seen this last year.
I think it's not priced in. First of all, let's be clear. Every investor that has a job today for the last 10 years bet one way, rates lower. So you have, in a way, a mechanism built in your brain where you don't believe rates can go higher.
So this is groupthink. I
agree. This is group thinking. I call it penguins thinking. Yeah, all the penguins on one side of the iceberg, and it says, hey, we're not going on the other because last time they went, we got flipped.
Yeah. Okay.
So secondly, there's a step change in function, which is, think about it. In the green transition, there are so many materials, but we just can't find.
Yeah.
And we have underinvested. And I think at the same time, third, the technological boom and the way capital made money the last 10 years, people are spending more money in virtual world that don't exist, rather than actually creating pipes and making water and air cleaner. Now, nobody needs a virtual game or a video game. You don't need to live it. But if you don't have energy, you don't make the winter. And so I think what's going to happen, you're going to have some capital reallocation.
How much of a dislocation would that bring? And actually, on the penguin thing, is there a danger that now we think there's too much inflation? Everybody thinks there's inflation, and again, you price that wrong.
No, zero, because the rates are still at zero. It's just the idea of it.
But it's the expectation.
Exactly, but just the idea of it, just the idea that we might be wrong has led to a market correction. But the reality is they haven't hiked rates, and they still need to go. The Fed is telling us 2.5. The market is pricing below. And just the idea, I understood about 2 years ago, I sent an email out saying we think 10-year bond is going to go positive. 3 of my largest contacts in the industry, they insulted me. No, they insulted me. It's even worse. Meaning, they said, you're mad. And says, what's wrong in your brain? I said, well, listen, if I take the cumulative inflation last year and the next 2 in Europe is going to be around 10 to 12%. So if you have 100 euro for 10 years at zero, and you have 12 that you lose in real power, you've already lost 12. Now, who wants to put 100 and get 88 back.
Yeah.
Now, then assuming there's no inflation year 3 to year 10. So it's obviously, you don't need to be Warren Buffett to understand that this is not a good investment, yeah?
Okay, I like the way that you don't have to be Warren Buffett. David, what's the fair value actually of Italian yields? I mean, once the ECB starts selling, who's going to buy this stuff?
Well, I think on that one, then, there's a change. Remember, now central bank own 30-40% of its debt, and they're not going to sell it. And they're going to
eventually they'll have to.
I don't think so.
So they're just talking.
My view is to just talk. Remember, they're not hiking rates. They're keeping rates negative. They keep on buying. So I think what we're going to do ultimately, all that central bank debt in the UK and the US is basically frozen. Okay? So there's going to be an agreement between government and treasury, but what happens is you don't buy more, you freeze it, you reinvest the coupon, and so basically it's a washout. So for all intents and purposes, that debt doesn't exist. It's like you have it in the right pocket, goes in the left, you keep on exchanging it.
And the Germans would be behind this?
The German, I think, will be behind it.
They would vote for this?
Yes. Also because, to be honest, they made a mistake. In Germany, they've been borrowing at 0 rather than borrowing at 1 to 2 like the US would. So de facto, on their overall debt, in Germany, it's about 6 to 7 trillion gross debt. They've been borrowing 1% below where they should have been borrowing, just hadn't been borrowing like the United States. And hence, they cannot keep on saying, hey, you need to pay, when in reality they are being subsidized by the rest of Europe.
I need to go back to the banks. So when you look at the strategy, I think you were an investor in UBS, but not in Credit Suisse. Is Credit Suisse just going to be taken out at some point in M&A?
Listen, I think Credit Suisse has a valuable franchise, has a valuable brand, and has valuable clients. So I think there will always be a bid for Credit Suisse, medium to long term. Clearly, an Archegos and Greensill, 10 billion for 2 accounts, which no one has ever heard of. But you're banking the Queen or Unilever, yeah? You're banking 2 guys, never heard, really, to the street. I think it's a clear, massive problem in who they selected in giving credit to. Because, had they been giving credit to Swissair, as they lost money. I remember when I was young, 15 years ago on Swissair. Fair enough, yeah. But it's very different, to lose.
So it was just too much risk, right? They weren't looking at the risk.
Wrong clients.
But how do you differentiate? So now that they're much more risk averse when it comes to lending, they'll be safer, we think, maybe. But how do you differentiate between a UBS and a Credit Suisse? If you're a client, who do you go to?
Well, to be honest, I think from the guys on the trenches, they're still doing their work. I don't think there is major difference operationally. In risk appetite, there's always someone taking a bit risk, more risk. Here was a question more, I think, that what happened is through the cultural change, someone must have given very aggressive target. Someone must have, thought that, growing risk and growing revenue, they would get paid personally. In reality, then they end up leaving, $10 billion loss behind on 2 clients.
On 2 clients.
This is what I think it's unacceptable.
Okay, very, very quick in 10 seconds. Your favorite European bank? Is there anything you're investing in?
Today we have a mix. I mean, we have, for example, Standard Chartered in the UK. I think it's brilliant in terms of Asia growth. Asia Connect, I think, is going to make a difference. We have Santander. We love it because on 7 times earnings, never lost money, and and is 25% of the earnings in the US. And then we like Intesa and UniCredit because they're returning us 30-40% of the market cap in cash. So they're saying we're not expanding, we're not going crazy in M&A, making money, and here's the cash back.
Davide, thank you so much, as always. Davide Serra there, the Chief Executive and Founder of Algebris. Now, pre-market check, Disney actually blew out expectations out of the water. Not only did they have more subscribers to Disney Plus, those increased by 11.8 million more people have been watching that. And that's, of course, a streaming service, but also more people showed up at the Disney parks, gaining some 7% pre-market. And Uber, those sales also beat estimates because ridership is resilient, partly due to the pandemic, and also they gained on Deliver, gaining some 4.5%. Coming up, we speak to a chief executive, another chief executive on earnings day. Electronic device maker Legrand has reported better than expected fourth quarter revenues. Don't miss our exclusive interview with the chief executive, Benoît Coquart. He's coming up shortly, and this is Bloomberg.
As a matter of policy, we don't comment on individual conversations that may or may not have happened with specific investors.
Can you tell me, Alan, sorry, can you tell me if there is an ongoing conversation? If you don't want to say the specifics, I totally understand that. But is there a dialogue?
Yeah, so we don't comment on that kind of dialogue with individual investors, but all I can say is that the speculation is running far ahead of.
Well, that was Unilever Chief Executive Alan Jope speaking to our Danny Berger. Let's check in on the price action. Unilever under pressure like Credit Suisse, but actually not as much. But of course, questions about the strategy going forward and what that means for the future of the Chief Executive. Unilever down 2.8%. Now, electronic device maker Legrand full-year revenue has beaten estimates. The firm says performance was driven by organic growth of 13.6% year-on-year. Now, joining us now is electronic device maker Legrand Chief Executive Benoît Coquard. Benoît, thank you so much for joining us. I have a million questions on, of course, the supply chain issues, on some of the things that you see with inflation. First of all, were you able to pass on some of the costs because of the higher inflation that you're living through, what you're producing?
Well, hello, thank you for inviting me. Well, indeed, the inflation was very significant. To give you a number, the price of raw materials and components increased by 11% in 2021 compared to 2020, so it was pretty significant. We passed on part of that into selling price. Our selling price was up 3.5%, but we decided not to pass it all in order to remain competitive and to fuel our growth. But indeed, it was quite a complex environment in which to operate.
So you have been a very acquisitive company. Are you on track to actually buy anything more? Does the inflationary environment help with these things because you scoop up bargains when people are struggling to make ends meet?
Well, we've been able to continue to do deals. You could see this morning that we announced 2 more transactions. So in total, we have bought 4 companies in the past 12 months, totaling 250 million euros of sales. Well, I don't believe that the inflationary environment really impacts neither our appetite to buy nor the willingness of sellers to sell. So I remain extremely convinced and motivated to do more deals in the coming quarters and years. And we have a pipeline of 300 companies, so I think that there are a number of opportunities that will arise in the coming months.
How will you balance actually pricing with cost inflation in the near future? How are you expecting inflation to move onto 2022 with 2023 in sight?
I have absolutely no clue, and if you do, I'll be happy to get the information because it's of course something which has a significant impact on our P&L. No, I think the Legrand ability shouldn't be to predict very accurately because it's extremely difficult to know what the price of electronic components, aluminium, steel, plastics would be. As far as Legrand is concerned, we should rather retain our ability to react fast and adjust our pricing and adjust our cost management very early should there be anything happening on this front. So we want to be reactive instead of really having the ability to predict very accurately what will happen.
So what does that mean? Hedging? And actually, I guess, your success rests on products improving energy efficiency. How's that going? Will you be ahead of it as energy prices go up? Are people trying to switch to some of the products that you offer?
Yeah. Well, we have a number of products that we call the fastest expanding segments, which represent 1/3 of Legrand sales, and which are indeed all products that help to do savings in terms of energy in buildings, but it's also about data centers and connected products. 1/3 of group sales, and those products have been growing faster than the more traditional electrical products, and we expect this trend to continue. And indeed, the fact that the energy costs are rising should convince an increasing number of people to adopt those technologies that help to do significant savings. So it will be one of those many mega trends that will support the growth of the market long term and the growth of Legrand long term.
Yeah. Monsieur Coquard, our viewers may have heard there's a big presidential election in France this year. What are you hoping to get from the next president?
Well, we're not doing politics, any president which is going to be business friendly will be much welcome. But we're not doing politics at all.
No, of course you're not doing politics.
And by the way,
any policy
France is about 15% of our sales, so 85% is done outside of France, and we have a lot more added value than looking at every presidential elections in every single country.
Monsieur Coca, yeah, with all due respect, I mean, this is not about doing politics. It's about you have to, do business in a business environment that will be dictated by whoever becomes the next president. What have you thought so far, some of the dirigiste approach by Mr. Macron? I mean, he's blocked certain takeovers. He's been very proactive in terms of seeing what kind of economy and business he wants. Has that been helpful for someone like Legrand?
Well, there are many things, of course, that have been done and that have been very, very positive for the economy and for corporates. But again, when you're a company active in 100 different countries, you have to deal with politics as they are. You have to deal with increasing price of raw material and components. You have to deal with geopolitical uncertainties. You have to deal with health situation and pandemic situation. So it's quality of a company such as Legrand to be able to adapt to all those changes.
Thank you so much for joining us. Benoît Coquard, the Chief Executive Officer of electronics device maker Legrand. Now, coming up, a new president for the Boston Fed, the University of Michigan economist Dr. Susan Collins, is appointed in a historic first. More on that story next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the Boston Fed says its next president will be Dr. Susan Collins, the University of Michigan provost, and economist will become the first black woman to lead one of the 12 U.S. Reserve banks. All with us to discuss all of this is Bloomberg's chief Asia economics correspondent, Enda Kern. Enda, thank you for joining us. So what do we actually know about the new Fed appointee?
Well, Francine, like you say, there's obviously the historic dimension, the first black lady to lead a Fed bank. On the economic side of it, Ms. Collins has spoken in the past of maybe lifting the Fed's inflation target above 2% as part of a drive to, make sure the labour market is red hot. That's not especially relevant now, of course, given US inflation is where it is. Figures tonight expected to show US data coming in at over 7%. Ms. Collins will rotate onto the Fed board, the FOMC, in the second half of the year, so she'll have a say on policy then. But the analysts say she's a straight shooter. She has international experience from the IMF and the White House, so by all accounts, she's been seen as a hefty addition.
So, and how might it actually impact the rates debate?
Well, like I say, Francine, the data tonight is expected to come in over 7%. Bring it back to the early 1980s on the inflation front. Obviously, that's going to dictate whether or not the Fed, starts aggressively ramping up its rhetoric for maybe a bigger move than expected in March, a bigger than 25 basis points move. And you would have to say that whether it's Ms. Collins or anyone else, I mean, the inflation train is already well underway, at least for the moment. Regardless of what her views once were on raising the inflation target, I think the Fed is committed to raising interest rates. The second half of the year, though, could be more interesting, and that's where Ms. Collins may have an influence. If you have higher rates and a slowing economy at that point, the rate hiking debate might become more complicated and more interesting. So I think, as I said earlier, Ms. Collins, she's described as a straight shooter, but the second half of the year could be more interesting.
Enda, thank you so much. Enda Kern, their chief Asian economics correspondent. Now, Bloomberg Surveillance Early Edition continues in the next hour with Matt Miller and Kailey Leinz in New York. Our Anna Edwards is in London. We'll have a full roundup of the markets. Credit Suisse under pressure. Unilever also under pressure, but Société Générale firing on all cylinders. That share price gaining 5%. This is Bloomberg.
We are at a point in the cycle where inflation is a major issue. I think central banks are dealing with a difficult environment here.
In terms of the Fed, I really think they're in one of the most difficult situations in our lifetimes.
It is not a good thing to raise interest rates to kill the economy.
This is Bloomberg Surveillance Early Edition with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong on this Thursday, February 10th. Our top stories today. It's one of the most anticipated U.S. inflation reports in years. Today's CPI data could determine whether the Fed goes for a supersized interest rate hike next month. European banks talk earnings and their bonus pools. Lenders are looking for ways to reward their stars and keep them from leaving. And Disney's earnings give a boost to a CEO who is finally on his own. Sales, profit and streaming growth all beat estimates. Later this hour, we'll talk earnings with two other chief executives, the CEOs of AstraZeneca and L'Oreal. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London. Matt Miller and Kailey Leinz join us from New York. Kailey, good morning. If I could sum up in two halves the day, this morning here in Europe, it's all been earnings, and later in the US, it'll be inflation.
Absolutely, Anna. About 3.5 hours to go until we get that crucial CPI print here in the U.S. Of course, Asian markets unfortunately had to trade today before they got that number. That won't be the case in the U.S. session. It was mostly positive in Asia overnight. The MSCI Asia Pacific Index posting a relatively small gain, all things considered, up about 0.5% or so, though you did have China lagging, interestingly, the CSI 300 down about 0.25%. Really interesting story, though, when it comes to Japan. Traders have been trying to test that yield curve control from the BOJ. We've had the 10-year JGB yield up around the highest since 2016, the 30-year the highest since 2018. Now the BOJ is out with an operation we haven't seen since 2018, offering to buy unlimited JGBs at a fixed rate of 25 basis points. Right now, that 10-year JGB yield is sitting around 23 basis points. So interesting moves from the central bank. The Japanese yen, meanwhile, is actually the biggest underperformer in Asia, as well as G10 FX. It's weaker against the dollar by about 0.2%. 115.77 is where we sit. And I wanted to point to iron ore as well, Matt, because we saw it under pressure yesterday as China looks like it's going to be investigating the rally we have seen. That weighed heavily on iron ore futures yesterday. They rebound today, though, up 5.5% in Singapore to 153 a ton. A lot of optimism about Chinese industrial spending shoring up this market, and that seems to be outweighing any kind of price control concerns we may be seeing, Matt.
All right, Kailey Leinz with a focus on commodities and the BOJ. I'm looking at, well, S&P futures aren't doing a heck of a lot, to be honest, but we had a pretty good rally yesterday after a choppy session on Tuesday, a sustained rally in stocks yesterday. Today we're down, but only 0.2%, and the U.S. 10-year yield is down just a bit, 193.71. Still a relatively high level for the U.S. 10-year yield. So we're still on that 2% watch, although our chief rates strategist, Ira Jersey, says 197 is really the important marker to keep in mind. NYMEX crude now coming down a little bit below $90 a barrel, but it had been up just a few minutes ago. Right now, 89.93, so close as darn it, as you say in England. And Bitcoin down just a bit, 44,418. Basically, you don't see a lot of movement, Anna, here in a lot of risk assets. I think really the market is waiting for those inflation numbers that we're all looking forward to.
Yeah, absolutely, Matt. And we're not seeing a great deal of movement at the overall level when it comes to equity markets. The picture here in Europe, either side of the flat line for major markets, entirely flat on the FTSE 100 and pretty much flat on the Xetra DAX in Germany. A little bit of a move to the downside on the CAC 40. We have seen some individual stories, though, really cutting through. And I wanted to highlight a few of those today because the earnings stories are really interesting because of what they tell us at the micro level, but also because some of the macro themes they tap into. Siemens, the German engineering business, really flying, a giant on the Stock 600 and up by 6% in today's session. Beating across the board is some of the commentary we got from some analysts, some of them now talking about whether we're going to get an upgrade to guidance coming through from the company in earnings reports still to come. AstraZeneca, we got new guidance there, up by 3.7%. We'll talk to the CEO shortly on this program about that earnings story and also about the hiving off of their COVID assets into a separate unit. What exactly is the plan there? L'Oreal is down by 3% in Paris. Was there a little bit of disappointment around some of the margins? Of course, bear in mind this is a business that does well, particularly when people travel and when people wear a lot of makeup and not face masks, and that those things are not entirely normal just yet. And so we'll talk to the management of L'Oreal a little bit later on. But there was a little disappointment there, at least in the market. Analysts were pretty upbeat on what they'd seen. Unilever down by 3.3%. Now, shocking and ugly are not words that you want to see attached to your earnings reports by analysts, and those are two of the words being used, cited by our colleagues on the Bloomberg terminal. A lot of concern around pricing, around costs. Also, they had to come out with some sort of damage limitation around strategy. They're doing a buyback, and they said they won't do any big transformational M&A. The market was really spooked by their intentions towards GSK's consumer assets, Kailey.
All right, well, we will continue to pay attention to some of those company stories in Europe. We also want to pay attention to the headlines we were just getting out of China in regard to new yuan loans for the month of January. Hit a record of nearly 4 trillion, 3.98 trillion yuan. The estimate is only for 3.7 billion. Also, when it comes to aggregate financing, that too topping estimate estimates 6.17 trillion yuan relative to the 5.4 trillion estimate. So a lot of new yuan loans in January for China. Now, what else are we watching today? There is a lot ahead, including geopolitics. UK Foreign Minister Liz Truss will meet with Russian Foreign Minister Sergei Lavrov in Moscow. The Ukraine situation still is front and center. Then in regard to earnings here in the U.S., Twitter will be reporting in just a few hours' time. 7 a.m. Eastern is when we expect that. And then finally, the big event of the day, U.S. CPI data at 8:30 a.m. New York time. Investors are bracing for what could be the hottest inflation print going all the way back to 1982. We are talking 4 decades. For more on that data, we're joined now by Michael McKee, Bloomberg International Economics and Policy Correspondent. Mike, 7.2% is what we could be looking at.
Yep, Ronald Reagan was president of the United States. Margaret Thatcher was prime minister of the United Kingdom, and you were probably anchoring this show, 1982. All right, we're going to be watching. A lot of people on the markets are talking about this as something that could push the Fed to 50 basis points in March. Not going to happen. The Fed's not talking about that unless we get some huge surprise. Here's what the Fed's watching. They are watching the inflation expectations, and this is your post CPI thing to look at. If we don't see inflation expectations rise, then the Fed's not going to be worried. This is the University of Michigan's one-year consumer expectation for inflation. But you notice then it comes back down again, and all of the inflation expectations in the markets are in the Fed's range, roughly. So it's not something we're going to particularly worry about unless that changes. Here's what we will take apart from the survey. Goods versus services. We bought a lot of goods because we were stuck at home. We weren't going out to restaurants. Does that start to change and push up services prices or pull down goods prices, energy prices? This is an odd month. They were generally flat in the futures market during the month, although they've ended up higher in February. Homeowners rent. House prices up 17.5% last year. That should continue to feed into the CPI. And then, of course, always, as we have had it before, a reopening trade. Used cars, are they still rising? Insurance has been rising. Lodging and airfares and food, things that people notice when they're traveling. Those things are what we're going to be watching today. You mentioned at the top, Anna, that we were going to be looking for signs for the Fed. It will be something they'll be watching. Also, we haven't had CPI as a big news story since 1982, so if you see me back here in the coming months on CPI days, you know the Fed's got a problem.
I have to point out, it's not just used cars, Mike. New cars also. The inflation has been pretty striking, and that's helped them pad margins, of course. Michael McKee there, International Economics and Policy Correspondent, talking about the number that we're all watching for the market expectations ahead of the inflation print. We're joined by Ksenia Galuchko, who leads our coverage of EMEA Equities Services. So, Ksenia, you know, it looks like right now markets are kind of sitting on their hands waiting for this print. How could it go?
Yes, it's really interesting. Of course, the market is expecting that the inflation print will be very high. We're expecting the highest U.S. CPI in 40 years. It's a pretty crazy number, but the market is ready. It has been pricing in this number for weeks now. Again, the stocks and bonds have been extremely volatile this year, but there is a sense now that the bond sell-off and the sell-off in tech stocks might have hit a low, because we're seeing bonds recovering this week. We're seeing tech stocks starting to make a comeback. So all eyes will be on the data tonight, which will determine the outlook for the bond market and for these sexy growth stocks that investors have liked so much over the past few years.
Okay, lots to think about in terms of US inflation. Ksenia, I want to ask you about the European inflation outlook, and in particular the ECB's inflation outlook, and how much everybody trusts the numbers, the assumptions, and the methodology that the ECB used to forecast inflation. I ask this because of a great scoop from our Bloomberg colleagues. A growing number of ECB policymakers are losing faith, apparently, in the institution's ability to correctly forecast inflation. What does this tell us?
Absolutely. It just shows us that there's so much uncertainty over inflation, right? There's so many players that think that this inflation could be temporary, but at the same time, we know that the ECB and the Fed are going to act to try to tame the spiking inflation at the moment. I mean, they're seriously determined to do this. What's interesting is that what we've been hearing from strategists is that despite the hawkish tilt in ECB's policy, European stocks are still very much in favor, because as yields rise, as rates rise, European stocks, which are very much exposed to value sectors like banks, like energy, like cyclical stocks, like miners, will actually continue to benefit. So unlike the US stocks, increasing number of strategists like Morgan Stanley, JP Morgan, are favoring the European stock market in this context.
Yeah, well, we've seen those calls before. They haven't always necessarily played out the way that we think they will, so we'll see if they do this time around. Thank you so much to Bloomberg's Ksenia Galuchko. Now over to Washington. President Biden's approval ratings have fallen in recent months amid rising prices and a stalled economic agenda, making it harder to get inflation under control, and that is all the more important for him ahead of crucial midterm elections. Jack Fitzpatrick, Bloomberg government reporter, joins us now from D.C. Jack, how does the administration manage this messaging?
Well, for one, they are trying to talk about the flip side and point out the pretty strong and sudden jobs recovery, really as a defense of the fiscal stimulus that is being blamed in part for so much inflation we've seen. But it's clearly an issue that's difficult for them to explain away. You've heard them get at, competition among meat processors, semiconductor manufacturing. A lot of those relevant issues are things that are not particularly easy to explain to the American public. Obviously, it is playing into the polls. You saw the CBS poll last month showing 65% of respondents blaming Biden for not doing enough on inflation. So you're going to hear him talk about the stronger jobs numbers, but also sort of struggle to come up with some way to talk this away, and really looking to the Fed to take action and trying to get results to bring these inflation numbers down.
We're hearing about the stock trading ban for Congress getting pushback. Of course, they have to make money too. Jack, what are you hearing?
Yeah, there has been some pushback. As this idea develops, we heard from Senator Pat Toomey yesterday, Tommy Tuberville. You're getting sort of almost a whip count and hearing who opposes this. But really, there does seem to be some developing momentum. There's sort of a change in the language that we've heard from Speaker Pelosi, who was initially very hesitant to take this kind of thing on. She has said that a committee should look at it and figure out what the options are. There are a number of details that would need to be ironed out. Is this an outright ban? Does it imply more limitations? Does it affect the spouses and family members of lawmakers? There's a lot of work that would need to go into this, but the developments from Speaker Pelosi and support for the general idea from Senate Majority Leader Chuck Schumer do seem to show that there is some momentum for this.
Okay, Jack, thanks so much. Bloomberg's Jack Fitzpatrick with everything you need to know from Washington. Turning to the European earnings story and specifically the banking sector, Credit Suisse warns that higher costs for pay and its restructuring will weigh on results in 2022. That's after reporting its biggest quarterly loss in about 4 years. The Credit Suisse CEO, Thomas Gottstein, spoke to us this morning about compensation.
The fact is that in 2021, the firm was loss-making, and as a consequence of that, obviously, we have to have a lower bonus pool. But we also included a new form of compensation in terms of our SDP, Strategic Delivery Plan. And this was very well received by our employees. And Credit Suisse is very committed to pay market rates in terms of compensation.
Thomas Gottstein there from Credit Suisse. Bloomberg's Danny Berger has all the details on the banking sector today. Danny, a big focus on compensation and no change in strategy. That was certainly the pushback we were getting from Credit Suisse.
Yeah, I think it is really fascinating to look at these banking results through the compensation lens, because at some point it does become this feedback loop. You want better results to be able to pay your talent up more, especially in this environment where there's high competition, to continue to allow the hits to keep coming. Now, looking at Credit Suisse and SocGen, for example, they're almost mirror opposites of each other, both reporting earnings today. Credit Suisse down 4% after that 2 billion Swiss franc hit for the results. SocGen up 4%. So again, opposites. In SocGen, the story was all about massive bonuses. Results were good across the board. Even equities trading was up 23% compared to 0.5% for Wall Street. I spoke with the bank's head of banking earlier this morning, and he described massive bonuses that were coming for the firm's bankers. He wouldn't give me an exact number. I did press him on that, but he did reiterate it would be massive. Now, compare that to Credit Suisse, where at the bank, they've had to reduce their bonus pool by 32%. According to sources, this is after talks with regulators about their worst year since the financial crisis. We did hear from the CEO there talking about a special reward that they are going to be paying out. It's about equivalent to $540 million. However, In total, that's still a decline of 15% in terms of rewards, but they're going to have to pay up. They really do. They've said this, and it's in order to retain talent, to make sure their results can resume any sort of strength after a very difficult year, Kailey.
All right, it's all coming down to the money for those bankers. Thank you so much to Bloomberg's Danny Berger with a look at the European side of earnings today. We have to talk about the U.S. side as well, because Disney reported a blowout first quarter, sales earnings beating analysts' forecasts, giving a boost to CEO Bob Chapek, who's finally out of the shadow of his predecessor. Bloomberg's Emily Chang spoke to him yesterday.
And it's really almost directly a function of what the new content is that's flowing into the service. And obviously that content was impeded and made a little choppy even more by the fact that, we had COVID and it interrupted our production cycles.
That was the CEO of Disney there. So let's take a check on how Disney shares are trading in pre-market. No surprise, probably, with the blowout quarter. They are higher to the tune of nearly 8 percentage points. And of course, there's a lot of areas of strength here. The parks division doing really well. Plus Disney Plus, that all-important streaming service, posted way more users in the quarter than expected. More than 11.8 million new subscriptions, in fact. The Street was looking for 8.17 million, so a big beat there as well. It also was a beat when it comes to Uber, and this is interesting. A very different story than its competitor Lyft, which really got hit hard by Omicron on the rider front. Instead, Uber reporting the most riders ever, actually. It really also is benefiting, of course, from the fact that it has that food delivery segment as well. Uber shares are up about 6% in early hours. And another stock moving to the upside is Twilio, the software company. It is up nearly 18% after it says it will have profit on an operating basis starting in 2023. It also topped analyst forecasts, so a big reward for these shares this morning, Anna.
Yeah, so an earnings story, lots of inflation lines to look ahead to. We've also got the geopolitics in the mix. Let's just get to some lines coming through from Brussels. The NATO offices in Brussels hosting UK Prime Minister Boris Johnson. This is Jens Stoltenberg you see at the podium right now. He said earlier on this hour that he sent a letter to Russia's Lavrov, the Russian foreign minister, of course. He said that just a few minutes ago. And then we heard from the UK Prime Minister Boris Johnson saying he doesn't think that Russia has taken a decision on Ukraine yet. The intelligence remains, quote, grim on incursion risks. He's willing to talk to Russia on some NATO issues. We continue to monitor the geopolitics for you, of course. They're the outgoing leader of NATO, of course, Jens Stoltenberg. Coming up on this program, we'll continue to monitor the markets ahead of today's inflation reading with Julian Lafargue, Chief Market Strategist at Barclays Private Bank. What does he think is at stake in this report today? Plus, an earnings update from the chief executives of AstraZeneca and L'Oreal. This is Bloomberg.
Welcome back to Bloomberg Surveillance. We are simulcast on Bloomberg Radio and Bloomberg Television. I'm Matt Miller here in New York with Kailey Leinz, Anna Edwards with us out of London. We are waiting for the CPI print to come out for the month of January. And as you can see from this chart, if you're tuned in on television, but I'll walk you through it if you're listening on radio, we're looking at the highest level that we've seen since, well, this one only goes back to 2017, but I could take it all the way back to 1981 when I was 8, and it would still be the highest print. The breakdown, as Mike McKee was telling us earlier, has a lot to do with energy prices here in yellow, as well as pink. That's goods, as people started buying more stuff than services through the pandemic. Joining us now is Julian Lafargue, Barclays Private Bank Chief Market Strategist. Julian, what does this mean to you? How does it change your strategy if we get yet another higher print?
Well, definitely the market seems to be primed for a high print, but maybe a lower than what the official consensus would suggest. So if we were to get anything above 7.2 and closer to 7.5, that could spook the market. Our view is that the market is going to remain concerned about inflation for the foreseeable future, probably the next 2, 3, maybe 4 months until we start seeing those inflation print peak. And until then, what you really want to how you want to be positioned really is more on the cyclical side of things, as long as those concerns prevail.
Good morning to you, Julian. I spoke to Wei Li from BlackRock, Global Chief Investment Strategist, earlier, and I was asking how much risk appetite she had, and she was saying they're confident in risk assets at the moment because even though the market has brought forward rate hike expectations, she said terminal rates are still pretty low, and as long as that is the case, that is the thing that will drive the perspective around risk assets. Does that sound familiar to you?
It does. That's why we remain constructive over risk asset in general. There is no alternative mantra has taken a hit recently, obviously, with the 10-year closer to 2%. There's starting to be some kind of alternative, and we would be looking for 2.25% on the 10-year maybe as an opportunity to lock in rate. But the reality is, over the long term, you still have much better upside potential on the equity side, and we don't think rates are going to go much higher than now.
So we aren't going to get to the point where rates mean that investors don't have as much appetite for equities then?
Well, we believe that it's partly reflected in the price action that we've seen here today. You've seen some derating on the equity side as rates move higher, but we do think that a lot of that move has already taken place. Valuation on the equity side will be constrained, but equally, we don't think they're going to collapse. And so we're probably there in terms of valuation re-rating. And the upside is going to come down to earnings going forward.
Does that mean we've also already seen the bulk of the value rotation?
Well, in our view, as I mentioned, we probably have a few more months to go because the market won't feel that we've peaked in terms of inflation until we have a couple of prints that are showing that peak. So we're probably still in there until maybe March, April. But at that time, we think it's going to be potentially an opportunity to revisit the growth spot of the market, which has been left behind so far. So we're probably two-thirds of the way there.
All right, Julien Lafarge, Barclays Private Bank Chief Market Strategist, thank you so much for your time this morning. Now, let's get to the first word news. And the protest blocking freight traffic from Detroit to Canada is starting to hit crucial supply chains. Ford has been forced to temporarily shut a Canadian engine factory and will operate another plant at reduced capacity. Protesters angry over COVID restrictions have blockaded the Ambassador Bridge between Detroit and Windsor, Ontario. A University of Michigan economist will become the first black woman to lead one of the Federal Reserve's 12 districts. The Boston Fed says Susan Collins will be its next president. She'll also be a rotating voter on the central bank's policy. And a warning from Unilever, the maker of consumer products, says it will take 2 years to return to the profitability level of 2021 due, shocker, to high inflation. Bloomberg Danny Berger asked Unilever CEO if he's had conversations with activist investors.
As a matter of policy, we don't comment on individual conversations that may or may not have happened with specific investors.
Can you tell me, Alan, sorry, can you tell me if there is an ongoing conversation? If you don't want to say the specifics, I totally understand that. But is there a dialogue?
Yeah, so we don't comment on that kind of dialogue with individual investors, but all I can say is that the speculation is running far ahead of the reality.
Activist investor Nelson Peltz's Trian Asset Fund Management has built a stake in Unilever. So Unilever, of course, one of the earnings stories out of Europe we're watching this morning, Anna, but we have gotten a deluge of them, and we will be speaking to more CEOs over the course of this show as well.
Absolutely. We're going to be speaking to the AstraZeneca CEO, expecting sales and profit to rise this year. We'll speak to the CEO, Pascal Soriot. That conversation coming up next. The business has decided to put its COVID assets, that's the vaccine, but also other treatment, into a separate unit. What is the plan for that unit? We'll ask about that and other drugs-related developments over at AstraZeneca. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. And here is what you need to know. Today's report on inflation in the US could push the Federal Reserve to its largest rate hike in more than 2 decades. The Consumer Price Index is out at 8:30 New York time. A reading above the projected estimated 7.2% annual increase may pressure the Fed to consider its first half percentage point hike since 2000. European banks look to reward their star performers. Societe Generale says it will massively raise its bonus pool after posting record profit. Credit Suisse slashed its bonus payouts by 32% after its worst year since the financial crisis. Still, it found a way to give senior bankers an extra long-term award. And Disney's earnings gave a boost to the CEO, who finally is on his own managing the business. Sales, profit and streaming growth all beat estimates. It is the first earnings report under the CEO, Bob Chapek, since Bob Iger stepped down as Disney's executive chairman. In a few minutes, we'll continue those earnings conversations with two other CEOs from AstraZeneca and L'Oreal. That is a look at what you need to know and a bit of a look at what is still to come on this incredibly busy program, a busy morning here in Europe. Not going anywhere at the overall index level, Matt, but that doesn't really tell the full story of what's happening here in Europe today.
Yeah, well, for sure. In Europe, you're seeing huge volumes. I was just looking at the WEI screen. You can click a box for average volume at time and see big jumps on the continent, 20, 30, 40, 50% more volume than you'd seen on the average of the last 30 days. Here in the U.S., we're not seeing a lot of movement in terms of the price. S&P futures, for example, down 0.2%. Maybe not a huge surprise, as we were up big at the close yesterday, 1.6%. The U.S. 10-year yield coming down a little bit as investors buy that debt, but still at a relatively high level, 193.71. NYMEX crude just holding around $90 a barrel and Bitcoin around 45,000. Of course, we're all waiting for the inflation print to come out, and a lot of traders may be just sitting on their hands until they have that news at 8:30 a.m. New York time. Kailey, what are you seeing in terms of pre-market action?
Well, of course, we're all paying attention to that macro inflation story, but there's also a lot of micro stories out there when it comes to earnings, Matt. And one of the big outperformers this morning is Disney. Blowout quarter, parks doing well, streaming also topping expectations. A lot more subscribers signing up for Disney Plus than analysts anticipated. Plus, profit came in 86% above analyst estimates. I believe one could call that a big beat. So that stock is up about 7.7% in early hours this morning. Another stock moving to the upside is Uber, recording its most active riders ever. Very different story than Lyft, which saw a big hit due to Omicron. Uber, of course, benefiting from the fact that it also has its food delivery segment. That stock is up nearly 6%. Also moving higher to the tune of about 12% is Mattel, beating expectations on really strong demand for toys like Barbies and Polly Pockets. And finally, one more story that we are waiting for. Twitter is due to report at 7 a.m. Eastern time, so just about an hour and a half to go. It is up about 0.8% going into that print, Anna, but still it's down something like 12% on the year so far.
Kailey, let's have a look at some of the European stories. And as Matt said, high volumes here in Europe, but the overall index not really moving all that far. But we do see some big movement in individual stocks. We talked about Siemens at the top of the hour. We've got a few different stocks in here this time. The Stocks Europe 600 then pretty flat as we wait for that inflation print later. But in the meantime, we do have big movement. For example, Credit Suisse down by 4.7%. Danny Berger gave us the latest on the bonus story and the concerns there around the bonus and staff retention. She gave us that a little bit earlier on. It has been a tough time, despite the tough environment over the last year and some of those self-made scandals. It does seem as if the business is sticking to the strategy. That certainly was the message delivered loud and clear by Thomas Gottstein, the CEO, this morning to our colleague Francine Lacqua. AstraZeneca and L'Oreal, two companies we're going to be talking to in the next half hour. So I wanted to just put in focus the share price movement we're seeing there. AstraZeneca moving to the upside, L'Oreal moving to the downside. The Astra story really interesting because they're talking about new guidance coming through. It didn't look as if that disappointed the market. The stock going to the upside, a big focus on their COVID treatments as well as other parts of the business. We'll talk about all of that. The L'Oreal story described positively by some of the analysts, but was there a little bit of a miss on the margins? Something to talk about with the management team there. And when do we see normalization in makeup wearing habits and crucially in travel? Until those two things happen, Matt, it's difficult in this kind of difficult for that kind of sector. Strength despite those headwinds, I suppose.
Yeah, absolutely. Very interesting conversations then coming up. A slew of corporate earnings producing mixed results this morning. We caught up with a number of other CEOs for their perspectives. Take a listen.
It's clear that the first quarter will be significantly lower than last year.
Our core focus is to get the great portfolio that we have today performing to its full potential. And I think in these latest quarterly and full year results, you're really seeing the step up that we've been talking about for a number of years now.
We are managing through that crisis, supply chain crisis, quite well. We have a very strong team, a strong supply chain management team. We have strong partnership with our suppliers. But it's also the Siemens power behind it, which gives us a little bit more leverage.
The headline is
our turnaround is complete. Mattel is in growth mode, and our strength is very broad-based. And as you said, we do expect to continue gaining market share and achieve strong growth in 22 and 23, and are not stopping there.
We're preparing for anything. I think if the last two years have taught us anything, it's to remain flexible.
A host of CEOs there and other executives talking about their concerns, their hopes and dreams for 2022. Let's get back to the earnings stories. And the UK drug maker AstraZeneca expects sales and profits to rise this year. That's given growth in its new cancer medicines and new COVID-19 treatment. Joining us now is the CEO of AstraZeneca, Pascal Soriot. Pascal, very nice to have you with us. Thank you very much for coming to talk to us at Bloomberg TV. You've given new guidance to the markets today, sales guidance, the high teens percentage growth 2022. I wonder, when you try and craft that guidance, are you being conservative, realistic, or are these sort of stretch and challenging targets to get to? How would you contextualize those?
Well, good morning. And I have to say, first of all, we had a tremendous year in 2021 with a growth of about 38% of our revenue. And on the back of this, we're forecasting and guiding the market for high teens growth, which is almost 20%. And that is really driven by our tremendous portfolio of new products in oncology, of course, but also our newcomers, Alexion, rare disease products, and our antibody for COVID protection for people who are immunocompromised and don't respond well to vaccines.
And so the new targets you put out today, Pascal, would you describe them as conservative and realistic, or are they challenging?
Well, they are realistic, I must say. And, we always try to reflect our company growth and prospects as we see them. There are always, upsides and downsides in a forecast, but we think it's realistic, and we hope to be able to even do better than this.
Pascal, let me ask you about the new unit you're forming to house your COVID-19 assets. Typically, when a company does that, it could be planning a sale or a spin-off. What's the future of this unit and those assets?
Well, we have a number of assets in this very important unit for us. Of course, we have COVID assets, both the vaccine, but also our new combination of antibodies that are designed to protect people who are immunocompromised. This is the only product that helps those people who don't respond to vaccines. We also have another antibody for RSV in children, and we have a flu vaccine. So we have quite a number of products, and we are planning to build this division, not to sell it or spin it off.
In terms of the sales and profit outlook for the division, obviously that will tell us a little bit about your outlook for the disease. How do you expect this to play out?
Well, we believe that the vaccine will decline because we are now in a period of time where people are getting boosters. So certainly the number of units used will be declining, but the antibody will grow. So overall, we expect our COVID franchise to decline, but the rest of the portfolio will grow. And that's why overall as a company, we expect to grow by almost 20% in 2022.
If you expect some decline in the need for your COVID-19 assets, where in this pandemic do you think we are? Do you think we've moved into the endemic phase? Pascal, can you hear me?
Yes, can you hear me? Yes, sorry about this.
I'm just wondering what your assessment from your vantage point at AstraZeneca, where in this pandemic you think we are, and if we have moved into the endemic stage yet.
Yes. I think in many countries we are indeed moving to the endemic stage. Thank God the pandemic is slowly falling behind us. We will still need to continue protecting people with regular vaccination, probably mostly for people who are most exposed, most vulnerable, older people and those who have chronic conditions. We will have to protect the people who have been transplanted or have cancer or immune diseases with our antibody combinations, because vaccines don't work very well at all in these people. So there will be a need, like for flu, a need for regular protection, but mostly in most countries around the world, the pandemic is now behind us, I believe.
All right, well, speaking of different stages, you have been at AstraZeneca since October 2012. You are coming up on your 10-year anniversary as CEO. How long do you plan on staying in that role? At what point will it be time to pass the reins to someone else?
Well, I'm still very, very committed to the company. We still have a lot to do. We want to be a leader in oncology by 2025 and in each of our therapy of focus. So, I'm very excited. This is the best time to be in our industry. An enormous amount of new science is breaking out, new innovative medicines we can bring to patients. Of course, we have challenges. This industry is of course, always evolving, but very exciting. And I'm building a lineup of very strong managers and several who could succeed me. So the company is in a good place.
Okay, and you mentioned oncology and ambitions there, Pascal. I wonder what you make then of reports that US regulators may want to put the brakes on approving new treatments, new cancer drugs, and other medicines developed in China, amid concerns about the quality of studies that go into that. Is this something that at AstraZeneca you're thinking about will impact AstraZeneca at all?
Actually, I think what the FDA has said is that they want clinical trials done for oncology drugs to reflect the diversity of the population. Most pharmaceutical companies these days are very committed to producing data that will cover the various populations that exist in the United States. And so the FDA has said if you bring data that are purely done in Chinese patients, this doesn't reflect the diversity of the population in the US, and it's not sufficient for approval. So to some extent, it will reduce the competition coming out of China, because a number of companies had focused on developing a product for a quick indication in only Chinese patients. And quite frankly, it is not appropriate to request companies to develop their products in a variety of populations, but then on the other hand, accept purely Chinese data.
Okay, interesting thoughts. Thank you very much for your reflections on that and that full conversation. Pascal, thank you. Pascal Soriot, the AstraZeneca CEO, joining us from Sydney. Coming up on this program, we'll be back to the earnings story and sales at L'Oreal reaching a record high. We'll speak with the CEO of L'Oreal, Nicolas Hieronimus, joins us next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, Twitter CFO Ned Siegel. That's at 5 p.m. in New York, 10 p.m. in London. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York and Anna Edwards in London. Well, L'Oreal sales reached a record high last year as the cosmetics company staged a full recovery following a lengthy COVID-related slowdown. L'Oreal CEO Nicolas Hieronimus joins us now for more on the company's results. Thank you so much for joining us, Nicolas. The luxury unit is really what's interesting here, surpassing the consumer unit now. Is that going to be your most important business segment going forward?
Well, first of all, thank you for having me, and I'm very happy to comment the L'Oreal results. As you mentioned, it's a historic year, a historic performance, plus 16%, twice the growth of the market, and it's really a collective work. I'm going to answer to you about the luxury division, but I really want to say that we have a grand slam because all divisions, all regions, and all category had a growth that was better than the average of the market. As far as L'Oréal Luxe is concerned, it's true that it has become our number one business, and it reflects the aspirations of consumers around the world for superior products that provide greater quality and greater experiences. And it's quite likely that it's going to be one of our strong growth engines for the future, next to the Active Cosmetics division, which this year has a plus 32% growth. So it's actually the fastest growing division of the group.
Nicolas, very good to speak to you. Thanks for joining us. Let me ask you about inflation pressures that you're experiencing. I know that you've said this morning you're confident despite the raw material price increases. Is that because you're confident you can pass on those price increases to customers? How easy is that proving to be?
Well, first of all, it's true we live in an inflationary context on raw materials and cost of goods, but As L'Oréal has a growth margin of close to 74%, first of all, we can absorb some of his extra costs, and the rest will be offsetting it through a blend of different measures, which go from innovation. We tend to launch new products that are systematically more premium than the existing ones, but also through a different set of measures of revenue growth management, which entail formats, price increases, of course, new promotional strategies. So some of our products will take measured price increases, but overall, I think that if we look at the full year of 2022, I think the inflationary pressure should be manageable within our P&L.
How high are you seeing in terms of input costs? And what exactly are you seeing as the biggest problems in terms of materials to get hold of?
Well, today, the raw materials that are in our products that are affected by inflations are oil derivative like silicones or palm oil. We also have some extra cost in some of our packaging. But as I said, overall, between our revenue growth management's actions and also the work done by our operations teams to negotiate and shift some of our production to other formats, I think we can offset most of it.
What are you planning on doing in the future to avoid this? I mean, will you lock in longer-term contracts, Nicolas, when you find good pricing, good sourcing?
Well, we've always had a pretty strong and good relationship with our suppliers. We are a loyal and long-term customer. Of course, they are facing themselves some inflationary costs, so they probably can't commit over longer period of times, but it's a joint work we do with them. It's part negotiation, part redesigning our products, and in the end, that's how we manage it.
Something a little away from the sort of daily running of the business, I guess, Nicolas, is that the Sanofi stake that the business holds, I see your team describing that as the door is open on the Sanofi stake that some of your team have been saying this morning. It provides a nice dividend. I wonder what decides that strategy. What will decide whether how long and to what extent you continue to hold on to that?
It's just a question of both needs and opportunities. We've been a long, loyal shareholder of Sanofi, and we are keeping that stake in a very beautiful French company, and that delivers nice growth in dividends. And it's true that should there be an opportunity that requires a certain amount of cash for L'Oréal, we could, of course, dispose of that investment to make such an operation. If we take the buyback of the Nestlé shares, for example, we did not need to do that, to use that participation, and therefore we decided to keep it and to stay a strong and loyal shareholder to Sanofi.
Nicolas, your business is global, obviously, but your heart, no doubt, is in France, and we're heading towards the French election. I wonder if you have any suggestions as to what a policy priority should be under the new leadership or returning leadership of Emmanuel Macron.
Well, it's true. I'm a French citizen, and I'm very proud that L'Oréal is one of the few world champions for France. But as far as the request I could make to governments, I think for me one of the important topics of the moment, and actually it's linked to the French presidency of the European Union, is to try to align on the measurements and the KPIs of CSR performance, of non-financial performance, because there are different opinions, different KPIs, and we need clarity and the same rules for everybody. Now, if I answer your question as an individual, as a father of two sons, I was telling you about my son who's in New York, I would say that investing in education is probably one of the most important things to do, because that's what's preparing the future of this world.
Nicolas, thank you so much for your time. Good to speak to you. The L'Oréal CEO, Nicolas Hieronimus, talking to us here on Bloomberg TV. Coming up on this programme, we'll continue to follow corporate earnings and speak with Lynn Good, the CEO of Duke Energy, after their results. That's actually coming up a little later today, 10:30 a.m. in New York, 3:30 p.m. in London. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Anna Edwards. She is in London. I'm in New York. Kailey Leinz is off to another studio to join John Farrow and Tom Keene. So let's talk about what we're watching today, Anna. And I am very excited to head downtown to Spring Street to Ducati Motorcycles. They have a shop in Soho. I'm going to talk with the U.S. CEO, Jason Chinook, about this motorcycle, not this one, the one you saw just previously, the Desert X, and about Ducati's global sales. They hit another record for sales last year. The pandemic has been good to them, but it's been difficult to deliver all the product that people want because they have the same supply chain challenges and chip shortages that everybody else faces.
Yeah, absolutely. One of the really interesting talking points of the week has been the chip shortages or the supply chain issues more broadly. I thought it was interesting talking to one guest yesterday who said executives who don't know when this is all going to right itself just say second half of the year. That's when we're going to see normalization, and that's shorthand for I'm not really sure, but we're hopeful. Let us talk about something else I'm watching, which is CPI data. We've talked about it a lot this morning. Mike McKee giving us a great preview at the top of the hour. Is this really the print that's going to tell us whether we get 50 basis points from the Fed in terms of a hike in the month of March, or do we have to wait for next month to get next month's CPI, which will come about a week before the Fed meets? So that could be the crucial one. Bloomberg Intelligence saying this isn't going to be the peak. The peak will come next month, and it could be above 7.3%. So wherever we land today, that might not be it. That might not be the top. We might have to still have those conversations, Matt, about the highest inflation since 1982. What were we doing in 1982? We weren't following the markets so closely, I'm sure. More Bloomberg Surveillance is ahead. We'll hear from Jack Ablin of Crescent Capital. That conversation coming up shortly. Plenty of other guests to talk to as well. This is Bloomberg.